Welcome back. Jay Fagan here with the Mattox Group. In our home ownership, home buying seminar, we're about to jump into session 4, the money pit, challenges in home ownership. If you haven't seen one of the greatest Tom Hanks, Shelley Long romantic comedies of all time, look it up, The Money Pit. It's a phenomenal movie for date night, movie night, pretty family friendly as well. My wife and I love it. And considering the homes that we've owned over the last 15, 20 years, homes we lived in before that, Money Pit is a great analogy of some of the obstacles and challenges of homeownership. Case in point, as you heard me say, we bought our first home. 2 weeks later, the banks collapsed and the Great Recession was in full swing. We bought our second home 2 weeks into the global pandemic. And just a few short months after we bought that home, we had a giant wildfire in our backyard, got within about 200 yards of our back fence, and we had to evacuate for a week. Thankfully, everything was okay. And while it was a terrifying experience and we learned a lot from it, in the end, it all worked out. It doesn't always work out for everyone. So let's talk through some of the obstacles to successful homeownership. Home buying isn't all dream boards, window coverings, and write-offs. Homeownership has its challenges. First, we have to have a down payment. 20% is ideal. More is better. Anything helps. And it's rarely easy to build up that pile of cash. Private mortgage insurance, PMI, is generally required on conventional mortgages when the home buyer doesn't have at least a 20% down payment. This insurance isn't cheap. It's 0.6 to 1.2% of the mortgage. And it is required every month until you meet the eligibility requirements to eliminate it. Closing costs, as we've already mentioned, can be a real budget killer. I mean, as you heard me say, $1,200 in Section 1 costs for my first home, that was completely unexpected. That was not an expense we were ready for, and it was really a stretch just getting in. In the case of our second home, we're getting ready to close. Everything is shut down, and our movers cancel on us because of COVID and the rules, and they weren't sure if they could even do moves. And so we're scrambling to find another mover and the costs and adjustments that needed to happen in order to make all of that work out. And in the end, it did, but you've got to be prepared for the unexpected. In the case of a seller's market, these costs may be yours to shoulder alone, as we also saw in the case of certain government loans. As of now, summer 2025, going into the fall of 2025, it's, at least in our area, more so a buyer's market. We're seeing that across the country. So the seller may offer some credits and adjustments to help make this process easier. Irrespective of what the circumstances are, you need to make sure to set yourself up for success, be in a place where you're prepared for the unexpected. Now, then we talk about moving in. As I said, quite the experience for us moving in COVID. So remember, when you're home shopping, the sellers are campaigning. Once you've closed and signed all of that paperwork that I'm sure you read, you voted. Move-in ready is more often than not a marketing gimmick. Be prepared for the unexpected plumbing or electrical issue, the surprise pet-stained carpet, or the occasional unexpected bat family in the attic. Or in the case of some friends of mine who bought on a golf course. Now, I mean, buying on a golf course comes with its own pitfalls, and you would think going in, you know you're buying on a golf course. Be prepared for some expenses. What they didn't know is that the golf course and the developer were not one and the same. And the developer has no control over the golf course, no control over the developer. Everyone has abdicated responsibility in all of the agreements and disclosures. And there's an HOA because it's a golf course. And while at their core, HOAs, I think objectively have a good idea. We want to keep the neighborhood looking nice and safe and protected. They come with costs, they come with challenges. And particularly in the case of large communities, you only have one vote. And so rectifying those challenges isn't easy. And in the case of my friends, their HOA doesn't allow them to install nets between their home and the golf course. And the golf course isn't going to install nets. It doesn't own the property, and it existed first. And the developer didn't install nets because they wanted to make a profit. So what is the homeowner to do? Well, unfortunately, in the state of California and in many states, they're kind of out of luck because they signed the disclosures. They said they were aware their home could receive damage from flying golf balls. And their HOA has the ability to change their policy and allow nets. But of course, will they? So once you're in, you've got to deal with reality, which is why I encourage you to take your time, make a good, smart decision around the home that you choose, and be prepared to live with your choice. All these expenses and all those going forward are your responsibility. So be sure to buy smart and maintain a comfortable emergency fund and cash flow cushion each month to weather the unexpected hiccup. Unlike rental, maintenance costs are on you. Every year, taxes, insurance, utilities, they go up with inflation. Homeownership has great stability in that your monthly payment generally never goes up and can go down when interest rates fall. All these other costs simply get larger over time. So when we talk about a sustainable purchase for your family, we're talking about making sure it's sustainable in the long term. So let's get some real talk. What does it actually look like to own a home today? If we look at here on the Central Coast as a good starter home, the gritty nitty, if you would, we're going to assume for our scenario a $900,000 purchase price. That's going to be a home, depending on which town or unincorporated area here on the Central Coast of California, where you're probably in the 2 to 3 bedroom range, 1.5, 2 baths. You're in a nice neighborhood, good school system, easy access to commuting and amenities. So $900,000 purchase price. A 20% down is $180,000, which saves you on PMI and keeps the full deductibility on the mortgage. You're below the $750,000 limit. The closing costs in our scenario assume escrow prepaids for your taxes and insurance and up to 2 points to buy down the rate. In our scenario, we're looking at a 6.5% interest rate. Rates are dropping down to 6%. Historically, 5 to 8% have been normal. And if we look at the tea leaves and talk with our colleagues, there's nothing on the horizon that indicates interest rates are going to fall below 5% in the near or even far term. If we look out, 3, 5, 7 years. The era of free money, while enjoyable, and I count myself privileged to be upon it, isn't sustainable and it isn't consistently something you can expect or rely on. So when you're looking to buy, look in that 6 to 7% range to be prepared. If it's below, great. If it's a little higher, you're not shocked. Our first mortgage in 2008 was 6.5%. And at the time, everyone told us that was incredible. I can't believe you got such a good rate. This, of course, from parents and grandparents who were accustomed to the 12s and 15s and in some places 19, 21% in the early 80s. So in this case, at 6.5%, we're looking at nearly $3,900 a month in interest expenses, a first year total interest expense of $46,563. 1% California property taxes, we're estimating in the ballpark of $10,800. Annual property insurance at $3,000, although in areas with higher fire danger, that could be $6,000, $9,000, $15,000. Fire insurance can put a quality home out of reach. So you want to make sure you're buying an area where you can get good, affordable insurance. The monthly utilities, water, gas, electric, sewer, trash, somewhere in the ballpark of $600 a month on average. The monthly cost of ownership in our scenario is $6,784. The income to sustain that, looking at an ideal scenario where we're under that a third of net take-home pay, is $230,000 a year, a gross income of $325,000, where we're still putting 15% or $48,000 to retirement. In this scenario, we're assuming 2 kiddos. The tax brackets at the federal level are looking at 11.11%, 4.42% for California effective tax rate, combined 15.53%, and a total tax after itemizations of about $43,000. This would be an ideal, perfect, check all the boxes homeowner in California. Now, of course, I recognize ideal circumstances aren't available for everyone. So stay tuned for session 5, where we're going to walk through a variety of scenarios that our real life clients we've experienced with real numbers names redacted, of course, for their protection, to show you what a variety of different scenarios looks like to buy a home in California as a first-time homeowner. Stay tuned.